Wednesday, January 2nd, 2019, Maneco 64, home of alternative economics and contrarian views. This morning I want to talk about the bond markets again and something called the repo rate or a repurchase agreement and how that's affecting the markets right now. And I like to point out that I did make a video on the 29th of December, and I said, despite year-end stock rally, bonds are flashing warning signs. I think personally the year-end rally was a PPT rally on a very thin market, and I want to touch upon, of course, the bond market and this repo rate or the repurchase agreement rate. There's a very interesting article on Zero Hedge about that came out yesterday. So what time is it now? It's 7:41 a.m. London, so fairly early. Billy woke up today. When I woke up, he woke up. So he came down. He wanted to say hello to everyone, but he's back to sleep now. So what have the markets been doing? Well, I checked yesterday just before I went to bed. Markets open around 11, the futures market, London time, which is 6 p.m. New York. I saw the stock market started rallying, was up about 50, 60 points. I saw it traded up over 100 points. And this morning, though, the stock market is a lot lower. It's down 250 right now. Gold is at $12.85.30, up about $3. It's been as low as $12.78.60 and as high as $12.87.62. So gold prices continue to do well in the new year. Silver, not so well. We're down this morning, down about 5 cents, 15.44. The low has been 15.31 though, and the high 15.53. So silver a little bit under pressure. The Dow, as I said, right now is down about 250, just below 23,100. It has been as high as 23,443. So it looks like maybe this end of year PPT rally is fizzling out with all market participants, albeit not all. There's still going to be a lot of people away. Coming back, S&P down over 1%, down 28 points at 2480. The future NASDAQ 100 future down 1.25% or 80 points at 6252. Currencies, the major European currencies are not moving that much. The pound is unchanged, 127.54 or cable. Euro is up 0.1% at 114.80. The dollars continue to drop against the yen, and I noticed that New Year's Eve as well, that it dropped. And in spite of that, and before, during the PPT rally, the yen was strengthening and the stock market was going up, and I thought this doesn't make sense. Well, and it's continued to strengthen the yen as the dollar is down 0.25%. We're almost down to 109 now. It's 109.30 dollar yen. Dollar yuan down marginally. It's at 686.40. Oil price down 1% at 45. WTI Brent down 1% at 53.25. If you think the Maneco 64 channel adds value to you and you'd like to contribute or help the channel, check the links below in the description. Bond markets and the repo rate and repurchase agreements. As I said on the 29th, I noticed that bond yields were actually below where they were when the market really dumped on Christmas Eve, the stock market. At the time, I think the 10-year yield was around 275 to 74. And in spite of that, we closed the year with the 10-year yield below 270, while stocks had rallied over 1,000 points, which to me, having been in the markets for many years, didn't make too much sense. And it showed that there's probably some manipulation there in a very thin market, not many market participants around. And then the other interesting thing I read is about the repo rate. And this from this article that came out yesterday on Zero Hedge. It says repo rate soars most on record as yield curve goes nuts in year-end liquidity chaos. So these are two different things. The yield curve as well is something that I hadn't noticed, and one of my viewers pulled me up on it yesterday on the live stream, that the 1-year T-bill rate. And before I go further, I like to explain to people. So when they talk about to other people, and maybe even people who are in the markets, that they sound like they know what they're talking about, because it's in the treasury market, any security up to 12 months is called a bill. After that, it's called a note, a 2-year note, 5-year note, 7-year note, 10-year note. And after 10 years, the 30-year is not called a note, it's called a bond. So it wasn't the 1-year bond that rate that went up, it was the 52-week or the 12-month bill. You might think it's a bit silly, but that's the terminology. I hadn't noticed there was a 52-week bill auction, and the rates went up quite a bit just on Christmas, on New Year's Eve, to 262. While if you look at the 2-year yield, the 5-year yield, and the 7-year yield, they're all below that 262. So from 1 year to 7 year, the curve inverted. And why did that happen? Well, I told my viewer that it's probably because people are not too certain about Fed policy, whether they're going to keep hiking this year or not. And the 12-month bill, that rate is very closely related to the Fed funds. And Fed funds right now are at 2.25 to 2.5. So it makes sense that the 12-month T-bill is above 2.5 if the market still expects a chance of a rate hike by the Fed. Because you couldn't have overnight Fed funds target rate higher than the 1-year T-bill. So that's what happened there. Now, repurchase agreement or repo rate. Before I go into that, I like to explain to people, because I worked in the bond markets for many years. I actually did some repos or repurchase agreements, and they are complicated, so they're not simple. But I'll look at this, the Handbook of Fixed Income Securities by Frank Fabozzi and Dessa Fabozzi. This is like the Bible for the bond markets. Look how thick it is. And I've got the section here on repurchase agreements. So before I go into the story, let's find out what it really is. Because, we can read the story and maybe we don't really quite understand, the reason behind it being so important. So I'll read here from page 195. A repurchase agreement is the sale of a security with a commitment by the seller to buy the security back from the purchaser at a specified price at a designated future date. Basically, a repurchase agreement or repo, and there's also reverse repos, but I won't go into that. A repurchase agreement is a collateralized loan with a collateral where the collateral is a security. A security meaning it could be a treasury bill, treasury note, treasury bond. It could be a euro bond. It could be a corporate bond, a junk bond, anything. But usually a bond, a security. The agreement is best explained with an illustration. So let's look at the illustration. Suppose a government securities dealer has purchased $10 million of a particular treasury security. So usually a government securities dealer, they work for the major Wall Street banks, London banks. They're the primary dealers for the Fed, right? It could be Goldman Sachs, it could be Lehman. Well, it could have been Lehman. Lehman's not around anymore. Or Merrill Lynch, Bear Stearns could have been. Or J.P. Morgan, Bank of America, Merrill Lynch, all those suspects, and even HSBC, the foreign banks that are the primary dealers. Treasury security. Where does the dealer obtain the funds to finance that position? Of course, the dealer can finance the position with its own funds or by borrowing from a bank. Typically, however, the dealer uses the repurchase agreement or repo market to obtain financing. So it's a place where they finance their positions. In the repo market, the dealer can use the 10 million of treasury security as collateral for a loan. The term of the loan and interest rate that the dealer agrees to pay, called the repo rate. They also call it the general collateral rate now, GC, general collateral, are specified. When the term of the loan is 1 day, it's called an overnight repo. A loan for more than 1 day is called a term repo. And I'll just finish here. It says the transaction is referred to as a repurchase agreement because it calls for the sale of the security and its repurchase at a future date. Both the sale price and the purchase price are specified in the agreement. The difference between the purchase and repurchase price and the sale price is the dollar interest cost of the loan. So basically a repo agreement or repurchase agreement is a way to fund for you, especially dealers, primary dealers in securities, in the markets, investors, speculators, to fund their positions, and they usually do it from banks. So keep that in mind. So this article says repo rate soars most on record as yield curve goes nuts in year-end liquidity crisis. So I've talked about the yield curve already, but so now let's look at the what this article says about the repo rate. They call it also the GC repo, General Collateral Repurchase Agreement rate. While it's well known that dealers, there you go, dealers tend to window dress their books on the last day of the year by curtailing activity in financing markets, repurchase markets, to shore up balance sheets. What happened on Monday, New Year's Eve, left quite a few mouths wide open, with the general collateral rate or the repo rate trading around 2.5 on Friday. That was the Friday before New Year's Eve. Monday saw a historic surge in the GC repo rate that sent the rate surging by the most ever, spiking sharply to 6 and 1/8, 6.125% on Monday morning, with the bid and ask trading 6.5 to 575. Why is the bid and offer reversed here? Well, because a lower rate is a higher price, so it's a bit confusing, but that's how you quote yields. The higher yield is the bid, and the lower yield is the offer, because it's more expensive, the security, with the lower yield. Just after 10 a.m., after opening Monday at 375 to 4%, or 4% to 375, which was already nearly 1.5% higher than the Friday close. Incidentally, the broad general collateral rate was set at 245. The same as the tri-party general collateral rate. So on Friday, this rate closed at 245, which makes sense with the yields where they are in treasuries, around 2.5, 2.6, right? And it goes on to say, in fact, the closing print of 6 and 1/8 was the highest general collateral repo rate observed since January 2001, and just under 400 basis points higher than the Fed funds rate. And these people go on to say that usually at the end of the year, when dealers are trying to window dress, this rate goes up a little bit, but not as much as it did on Monday. It might go up 0.5%, but not like almost 400 basis points or 4%. So what do I think this means? Well, I think it means that there's liquidity problems in the markets, and that market participants are starting to, how can I say, not trust each other. There's little trust in the markets for that rate to go up that much, but people are not prepared to finance, dealers at the normal interest rate. So it will be interesting to keep an eye on this to see if this was not just a one-off. So what does it say here at the end? It says, as for the record spike in repo rates, traders were left scratching their heads, with curvatures skirm warning that market participants may have to start pricing in the fact that if repo rates spike up a bit, they could go much higher. What would be in my opinion, the consequence of all this? Well, it could show that people are losing confidence in each other in the markets, that they don't want to lend to each other. It is a funding market, and that could affect counterparty risk. And I think the biggest problem with counterparty risk would be all the over-the-counter derivatives, all the derivatives out there that work well when the markets are calm and there's liquidity and when people trust each other. But when people don't trust each other, the nominal size of these derivatives, which run, some people argue, into the quadrillions, more than $1,000 trillion, it could come home to roost, because usually we are told that it doesn't matter that it's 500 trillion or a quadrillion, because all the shorts and long match, and it's only a notional amount. But if counterparties start getting in trouble, look out, and that's what happened in '08. So there you go. First day of the year, a lot of uncertainty still out there. We'll keep an eye on it. So if you enjoyed this video, make sure you give me a thumbs up, share it far and wide, subscribe to my channel if you haven't yet. You can also follow me on Twitter, steemit.com, and on DTube. I'll talk to you later. Take care. Bye.